Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and we are back for Investment Friday with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. Hi, Brad. How are you today in September? It's officially September now.
Yes, it is. Welcome to the beginning of September. Just the continuation of the season of spend. My favorite time of year, back to school for everybody.
Right.
Universities all the way down to preschoolers. They're all, and all the parents are excited for back to school because now they are actively engaged in the good cause of becoming educated, and gives the parents a little bit of free time to get stuff done.
It's true. It's so true. So my kids went back in August, like August, maybe like 15th and then the 23rd. They're in two different schools. And one of my cousins lives in New Jersey. Their kids just went back to school this week. So I think they're one of the later ones starting in September. So yeah, everyone's back. Everyone's back in school now. So yeah, season of spend. We've also got season of job reports, right? So let's start with that. What did the JOLT report look like this week?
Okay, so the JOLT
Say what it
report.
is.
Okay, this is not a caffeine drink from the 1980s, but it is the job opening and labor turnover survey. So it's put out by the Bureau of Labor Statistics every month. And essentially what it said was the number of jobs available went down. Okay, and it actually surprised on the downside. So I'm going to share my screen very, very quickly. Just go over, we have a slide here and I'll walk you through it verbally if you're not watching. But essentially what we're looking at is a graph where on the horizontal axis is years. So it goes from basically 2000 through 2024. And on the vertical axis is the ratio of numbers of jobs that are open per unemployed person. So for example, if it's a ratio of 1, it's for every unemployed person, there is 1 available job opening. Okay. Now, this does not say these people all fit into these jobs. What it just says is there is 1 opening for every unemployed person.
Right. So someone in tech that loses their job, it doesn't mean there's a job in tech for that person. It means there's a job in retail or a job in construction.
Yeah, or a job in healthcare. I mean, it's generally the chronically undersourced job places that have an enormous amount of openings, and the people that are unemployed are in other industries, and there's a skills mismatch, but that's for a different subject for sure. But then it tracks through all those years that ratio, and on average over those years it's been 0.7 jobs per unemployed person. Okay. Well, in 2021 or 22, we got to a high of 2 to 1, where there were 2 jobs for every unemployed person out there. It was that talk of the labor market was so strong, wage inflation was really going up because no one could really find anybody to go to work during that COVID pandemic relief efforts. Well, now it's back down to 1. So 1-to-1 ratio. And that is basically where it was in 2019, is about a 1 ratio, which is historically a high number. So it still implies it's a good, strong job market, but it has cooled or softened substantially since the peak strength in the labor market back in 2021 and 22. So again, that's a really good sign. It gives indication that the Federal Reserve later this month will have the impetus to go ahead and begin reducing interest rates. And
Mhm.
that will help regional banks, that will help real estate owners, that will help um, smaller companies that rely a little bit on floating rate finance. All of those people should start to benefit as interest rates start to get lowered.
And that even flows through, right, to the consumer side with credit cards, with home refinancing, right? Anything that's tied to that prime. So if you say your loan is prime plus 2% or prime plus 2.5, right? That prime rate is a component of that is the overall rate that the Fed sets. So that's a big factor for a lot of, home buyers. That's an interesting piece of the conversation too is, what's going to happen with housing prices as rates come down. Is there still going to be, are we going to reaccelerate, right? It seems like the housing market has also cooled a little bit from what I've heard in a lot of areas. Houses are sitting longer. Instead of sitting for 3 days, they're now sitting for 7 days or 9 days before they even get an offer in some, where I am in Cincinnati anyway. But even longer than that in some other areas. So is that gonna kind of reignite if rates come down and mortgage rates come down? Are we gonna see another acceleration in the residential housing market?
Yeah, I saw an economist, a real estate economist, wrote a paper or wrote a research note on this, and he thinks that until mortgage rates get below 5%, um, it's not really going to unleash a massive amount of demand. He said most of the high prices in the housing market are due to short supply, very, very little supply. The home builders are not building nearly as many houses as we need to keep up with household formation and homes that are just decaying out and being destroyed. And so we need to start building more homes, more entry level homes is really specifically the area that needs to be addressed. Um, so it's an interesting dichotomy because his premise was this is a supply issue, not a demand issue. The demand is there if the supply is there and if the cost of financing is reasonable. So he said around 5% ish, we'll start to see that really start to pick up. Um, because most existing homeowners have mortgages far lower than the current rates.
Mhm.
And to incent them to move up, move out, whatever, um, it would take a pretty good pullback in that area in financing. Additionally, with the credit cards, I mean, right now in the United States, we have over $1 trillion in credit card balances at an average rate of 22%.
Mhm.
So those rates coming off will help a number of households with their budget because their credit card bill now goes down almost pretty quickly. So that will help households for sure that are carrying quite a few balances. Now, when I say $1 trillion, that is a ton of money. That is a record amount of money on credit cards. Um, but overall debt in the household is not terrible right now.
Mm.
Um, we've paid off a lot of debt since 2008 2009 when it kind of hit its peak, and households have retrenched a lot in terms of their debt exposure, and so we're actually pretty close to cyclical lows in that measure. So we have the ability to continue to spend from a household perspective as long as we think, one, our job is pretty secure, and two, that our incomes are going to grow somewhat in line with inflation, which right now they are growing probably a little well, shouldn't say that, probably a little excess of inflation. So um so that's been good for the homeowners and the households for this year, which is why we've seen consumer spending be a little more robust than people had anticipated, including myself earlier on in the year.
So having consumer spending be a little bit more robust so far this year, and then right at the beginning of the call, you said we're now in the season of spend. What do economists kind of think is going to happen throughout the rest of the year, right? Because like you said, back to school really kicks off, there's that influx of spending. I have 3 children. I know what it's like, right? They all need new clothes, they all need new shoes, school supplies, yada yada, all the stuff. And then we get into holidays. We've got Halloween. There's maybe some people are more into it. I'm not super into Halloween, but my kids love costumes and trick or treating. So we do that part, but I do know people who go super all out for it, right? The decorations, we've got Thanksgiving, we've got Christmas coming up. What is the expectation for holiday spend for this year?
Yeah, so I'll give you the conference board, which is it's a economic think tank essentially, and what they've forecasted is that the economy will accelerate through the third and fourth quarter of this year. Okay, um, so it means that the economic growth is going to pick up just from a seasonal perspective. It's just going to pick up. Additionally, if they do start to lower interest rates here in September, which I think is a foregone conclusion, then that will also add a little impetus to that spending. So yeah, we're probably going to accelerate. How much we'll accelerate, they're not forecasting an amazing amount of acceleration and real GDP growth, but it is accelerating.
So this is really interesting, because it kind of like dovetails into the next topic that I wanted to talk about today. Because again, we are officially in September. It's September 5th. We're almost exactly 2 months away from Election Day here in the US. So we've got a presidential election year. And right around this time, it's been happening, right? We've been in this a little bit, but kind of this last 2 month stretch is historically, where as an advisor, I have seen the most fear come up, the most questions from clients and questions from other people around, I'm just afraid. I'm afraid on both sides of the aisle. So this is conservatives and liberals, Republicans and Democrats, whichever side you're on, there tends to be this. I kind of like visualize it as this like vortex of fear, like this tornado of fear that like takes over the nation and our collective conscious, where people are just afraid that if the other person wins, if the other party wins, everything's going to hell in a handbasket. And, we've got like, well, if this person wins, there's going to be civil war. Well, if that person wins, anarchy is going to break loose. If this person wins, you know, uh, I'm just worried that the entire economy is going to completely collapse and money is going to be worthless. And it's so interesting to me because I hear it every 4 years, every 4 years without fail.
Predictable.
It's so predictable, right? It's like right on schedule. And again, it comes like both sides. I've never had an election cycle since I've been an advisor. So 2008, when I started in the industry, right? I've never been through an election cycle where it wasn't s- people from both sides sharing the same fear. And I'm first of all, I'm curious if you have had that same experience over the last, 30 years as well.
I will say over the past, basically since I'll say 2008, um, it has ramped up significantly.
Interesting.
Yeah, in the 1988s, so the first time I voted was 1988. So in 19, so the late 80s, early 90s, um, it wasn't as vitriolic as it is today, where the extremes of both parties, all they're doing is casting aspersions upon the other person.
Mhm.
They're not looking at, they don't talk about policies anymore. They don't talk about details in their policies, hardly ever. And when they do, they talk about with very broad brushes of what they would do. And um, I don't think that's a good trend. I think that they do need to be very specific about what they're going to do and have the nation get on board with them. or not. Um, but it has become much more fear-based since that time. Um, and I think in 2008 was more, it was easier to explain because we had a credit crunch during that same time. And so whenever you have economic pain at the same time you have an election, that fear coalesces together, where
Mhm.
now it's like almost existential, your fear for your investments and for your family and for the economy. Whereas today, I think, uh, I mean, yeah, everybody's fearful, but um, you know, from the real standpoint, the president doesn't control the economy. Never has.
Yep.
Not going to say never will, but we are an open market. We're an open market capitalist society. So unless we become a dictatorship or a communist country, we will not be a planned economy. We will be, for the most part, an open capitalist society. And Americans value their freedom of choice very, very much. And so we're going to protect that no matter what. Um, so for the most part, presidential elections may cause short-term fear, but generally don't impact the economy that much. Some of their policies can definitely affect it.
Mhm.
They'll either exacerbate the highs or the lows, depending on what they do, but generally they won't throw it off. Okay. It's usually outside influences that have that happen. Wars, when we go to war, that tends to do something. Um, Big terrorist activities, stuff like that. People that where or pandemics for that matter,
Right.
something from the outside that comes in. That's generally what affects the economy in a major way. Um,
So the analogy that I like to use, and I wanted to share again here. I don't know if I've shared it on the podcast before or not. So if you've heard this before, you're going to hear it again. But I think most people probably haven't heard it. The business cycle is the underlying, gauge of how the economy is doing. Right. And so, and actually, this would probably be a really good graph to put up too, if you have one, Brad, if you have like what the arc of the business cycle, do you know what I'm talking about? Um,
yeah, I'll try to find one real quick.
Yeah, so Brad is searching for this chart, that he knows exactly what I'm talking about, while I continue this analogy. So, the business cycle is the underlying, thing that can kind of controls the arc of the economy in the US and globally now that we're, like, more of a globalized economy, and that is, like, the tides in the ocean. We can really, like, map that straight over, right? The tides in the ocean are what control the movement of the waters on our planets. What controls the tides? The moon. The moon controls the tides. And so anything that is happening in the ocean, right? It's mostly from the tidal movements. On top of that, we can have things like hurricanes, we can have typhoons, we can have, really windy days that make really rough waves, right? So we can have all of this weather, all of this noise on top that, can either create beaches or, sometimes it can knock down houses. It can cause damage here and there. It can cause a ruckus, but it's just the waves. And the tides are going to keep going in and out on their normal cycle, no matter what the waves are doing. So I like to think of this. And if you're watching on YouTube, Brad put up the four phases of an economic cycle. This is like the tides. And it's beautiful because it even kind of looks like an ocean wave, right? This is like the tides of what we experience in the economy. So our political cycle in the US is like a storm, right? And so this vortex, even when I said this vortex of fear, it's like a tornado of fear. It's like a perfect analogy there too, because it's just a storm. It's just kicking up the waves, right? And so people can start to feel afraid. If you're in a boat in a storm, that can feel scary, right? We want to be in a boat on calm waters. We don't really want to be in a boat during a hurricane. That's when it can feel a little bit scary. But if we can zoom out and understand that, again, the waves aren't controlling the ocean, the tides are controlling the ocean. That's what the business cycle is to the political cycle. So, Brad, you want to explain a little bit more this business cycle that you've got up on the screen here?
Yeah, I mean, it's just the business cycle is when the economy's growing, we're in an expansionary phase. As we start to slow, we're going to hit a peak. Okay, that economic growth kind of stalls out. And then during a contraction, the GDP starts, the growth rate starts to fall. That's where we currently are. We're in a phase where the economic growth has begun to contract, right? We went from, 3-4% down to 2%, possibly hitting 1% in the third quarter here. We don't know. And in September, because of the lower interest rates, we think we're going to trough. We're going to hit that bottom area, that trough, and then begin to recover towards the fourth quarter or during the fourth quarter. So economic growth will start to accelerate back up to, a more normal level throughout. This cycle has been around since business has started and since civilizations, actually, it was even beyond, it was before civilization really started, when we were bartering with one another way back. So, it's just one of the things that the business cycle is here to stay. It always has been. It's based on sociologic and psychological factors, not just economic ones. And the seemingly very important items of the day may or may not have economic impact upon your investment portfolio. It's good to be aware of different risks in the world and different risks from the political sphere. But you can't overreact to those fears, because at the end of the day, most times presidents, Congress, they influence the business cycle, but they don't stop it. They may extend it a little, but they never get rid of it. And so it's one of the things that, the Federal Reserve, the reason why we have the Federal Reserve is to shallow out those downturns, those troughs. If the economy is starting to slow, we can use monetary policy via the Fed to help kind of bolster that growth, which is what they're doing, right? They're going to lower interest rates. That's going to re-accelerate economic growth at some point. And so, everything that happens modifies the business cycle. It doesn't eliminate it. And that is the more important part of that, is when, if you own companies and investments that are going to make money during a year, that's a good thing. And that's that's where your investment thesis has to come from. More often than not, people see people are fearful. They'll ask me, hey, what if this guy or girl wins the election? How's that going to influence? And I say, hey, let's say you own Coca-Cola in the portfolio. We don't. I'm just using it as an example. Are they going to still continue to sell Coca-Cola? Well, yeah. Okay, then don't worry about it, because whoever president doesn't influence how much Coca-Cola is drunk throughout the year around the globe. Okay. They may influence it a little bit. They may put some regulations on it or some stuff like that. And it might make it more difficult for the company to continue to grow their earnings at a rapid rate. But at the end of the day, they're still going to make money selling Coca-Cola around the world. So that is a bad example. I'm just using it as an example that, if you own a widely diversified portfolio, more often than not, you have some pretty good companies in there that are going to do just fine under either administration, whether, former President Trump wins or whether Vice President Kamala Harris wins. Either the companies are going to do just fine up during each of those periods.
And you drink enough Coke Zero to just keep the company afloat anyway. So
You got that right, sister. That is for sure. Again, that's my bad habit. It's one of
right.
my bad habits.
To-
So
totally fine. I'm totally just giving you a hard time. But I really like to just remind people when I get clients and friends who come to me worried about that, right? Because this is part of my job, especially the client fears part, right? Like they'll tell me what's worrying them. It's like, if everything does blow up, like let's take the thought experiment all the way, right? If everything does blow up and our economy is just decimated and there's nuclear war and the grid goes down and like everything is just, you know, chaos, what is your investment portfolio going to do for you in that moment? Right? If that's really what we're worried about, that's not going to be the thing that's going to keep you safe. Right? So it's like we have to, if you're going to be worried about it, right? And if we're going to take the thought experiment all the way through, there's nothing that money is going to help you with, really, truly, if the banking system goes down worldwide. Right? We're in so much more hot water than that. And at that point, you got to rely on your other skills. Um, I am not a doomsday prepper. I just say that I do realize there are risks, right? There are risks to the grid. There are risks to nuclear war. These are risks that exist in our world because of, the systems that we have in place. But if we take that mentality that we are always going to be preparing for the absolute worst case scenario at all times, that's where we lock ourselves in really to, all right, well, then that means your money can grow as much as you can earn it in the time that you have. That's it. There's not really another way for you to grow your wealth in a significant way if you're not allowing your money to work for you. And so that's if you feel like that's a risk, there's a risk on both sides there. Right. And so my choice is always to take the risk of let's trust that the market and the business cycle is going to keep doing what it's done for hundreds of years in the stock market. Well, 130 years in the stock market. And then for, like you said, thousands of years before that, before we had a stock market. My impetus is to trust that that's going to keep going in some way, shape, or form. And that if we need to pivot because of nuclear war, then we've got other problems to deal with first.
yeah, and I mean, even setting aside, people grew wealth throughout the entire history of man by owning companies, whether it was a small little mercantile store or whether it was a farm. You you were a factor in the production or distribution cycle. Those people are the ones that garnered wealth, whereas the people that worked under them or rented their farm as more in serf as a serf in Europe, they did a lot of the work, but they didn't accrue a lot of the wealth to that work. It benefited the landowner. Okay. So my suggestion to people is look at the risk in a probability weighted function. If you're really, really worried about the worst case scenario, then keep some cash in your house. Keep enough cash to make you not worry that if the grid goes down or if so and so gets elected, that the world is going to go, and you have to have survival money. Okay. That's great. Keep a certain amount of money at your house in a safe or whatever. And then that's your emergency money. Okay. And then invest the rest, invest for what you need to accomplish in your life to support your financial goals. And stick with it long term. Don't be caught off guard with these little bits of noise and volatility that come about every once in a while. Because if you step back, this election over a 40-year presumably investment horizon means nothing. Means literally nothing over that period of time. Now I always have people go, well, what if a civil war starts? Yeah, that's a problem. That will be a problem for any market around the world when you have a civil war going on within the country. Okay. I don't think we're going to have a civil war. I don't think we're to that point. Um, do we get there? No idea. But I don't think we will. I think there's enough reasonable people in the United States, because most of the people in the United States are in the vast silent majority middle.
Mm-hmm.
And you have very, very loud components on the far right, and you have loud components on the far left. And both those very, very far edges of the political spectrum, it's what they do. They're noisy. They cause a lot of issues with their noise, but that's all it is. It's just noise. You just got to tune it out.
So can you share that one more chart that I wanted to say, because September, right? We're talking about this 2-month period that we're entering right now. It could feel volatile. We could see some, downturn in the market. We've seen a little bit over the last, week or so, some things coming down. And again, if you're watching, we've got a lot of good stuff this week to see on YouTube. So go to the YouTube channel. It's Expansive CEO is the YouTube channel. Super easy to find. But you'll see here in this chart, it compares presidential election years since 1976. This goes all the way back to 1976. It averages out every presidential election year is the dark blue, and then non-presidential election years. So Brad, you said this means like midterm election years.
Yeah, congressional elections.
So there is an election, but it's not the presidential election. They averaged all of those, and that's the light blue on this chart. And what we see is that the presidential election years are a lot more volatile. There's a lot more seesawing happening in those presidential election years, and especially in this September to November timeframe, we see like a a decent contraction from the high in the year. But what happens at the end of the year? It ends higher. It ends higher than the previous peak. So it's got at its highest point in the year at the very end.
Yeah, I mean, the average of all presidential election years is about 8% growth on the S&P 500. So what I think, Hannah, you were really getting to is the end of September is usually the peak, is the intra year. It's within the year. That's the peak. And then we go through this a pretty decent pullback between the end of September or, mid-September all the way through the election. Once we have the election, the market starts to climb back in a pretty significant way to end the year higher. And, in presidential election years, it's not that pronounced. The September, October timeframe is always more volatile. It's the most volatile part of the year for a lot of reasons, but adding a presidential election onto institutional rebalancing, onto tax loss harvesting starting, all of those, it just exacerbates those trends in a major way. So what I try to tell people is, look, if you're going to be, I would suggest you're politically aware, but don't be overreacting to some of the political stuff out there, because it influencing the overall economy. If earnings are going to grow in the S&P 500 or in the overall market, equity market, then stocks are going to do fine. That's the general rule. If earnings are going to not do fine, then the equity market's not going to do fine. So generally, it's why presidents that are more business friendly generally have a better response from stocks overall than ones that are less favorable. But yeah. So just get prepared some volatility. If you've built up excess cash, this is a great time to put it to work, by the way.
Yeah.
So I know a lot of investors have some cash on the sidelines out there. And if you do have excess cash, please use these pullbacks over the next month or two to deploy that back into the market, because it's going to be on sale and earnings are still growing. So it's a short term, a little bit of noise, but it's a good time for an entry.
Beautiful. Well, that's the thing that I wanted to really share today. And we kind of beat this drum plenty, right? But that sense of understanding that temporary pullbacks are not the end of the world, right? It's really like when we feel that is the job though. That's the job of, me as a financial planner, you as a financial analyst. That's our job, is to interpret these signs and then to explain it in a way or help people feel comfortable with, okay, it's going to be okay. I don't need to, take all my money out and hide it under the mattress. Um, because, and, all of the stories that we shared are because, we've had people come and say, should I sell everything? And it's not, should I sell everything? Should we go to cash?
Right.
Should we go to cash? That's the phrase that comes out of people's mouths. Should we go to cash? And the answer to that is almost always no. Almost always no. There's never a chance that that could be the right option. But if it's, I'm worried about the election, should we go to cash? My immediate response to that is, we're worried about the election. No, we should not go to cash. Why? Because here's the historical. If we go to cash now, are you going to buy on October 28th when, okay, the market's down 7%? Are you going to buy then so that you hit the upswing, or are you going to still be afraid that it's going to get worse because the election hasn't happened yet? Right? And then the election happens and everyone's like, oh, okay, it's great. And whoever it is, right? Things are going to be fine. The markets start swinging back up and then you've just lost money because you get back in after the market's already grown past where it was when you sold.
Yeah. I think I told you the experience, and I'll share with the viewers and the listeners. Um, I've known a lot of individual investors to sell at the right time. They're worried about the economy. They they either work in an industry where they see the economy slowing much more dramatically than others do. So they take advantage of that information and they sell their portfolio. Okay. They make that choice. What I've never seen happen is someone who has sold at the right time and then repurchased at the right time. Generally, just to your point, when the market goes down and when they should be buying back in, what happens is they get more afraid that it's going to go down lower and that they're going to lose additional money. And so they don't buy until they want to feel good about the market, which is typically when the market's up 10 to 20% from their sale price.
Right.
So they've now lost money on that sell. And so when you sell, you now have another decision point, which you have to be correct on, which is when to buy. And if you're not capable, or you don't think you have the emotional wherewithal to rebuy when the market looks at its worst, then I would say do not sell, do not trim, just ride out these small little volatilities.
Mm-hmm. Yep. That's the cycle, right? That's the cycle that we can get into. And why a lot of, you know, why people go to financial advisors in some cases, because they don't know and they feel afraid. And like, I don't want to manage that. I don't want to have to make that call. So it's an interesting thing to coach people through, to experience. I mean, I'm invested, right? I go through it too. In 100% transparency, I never sell. So it's just keep putting money in. Just keep putting the money in, let it do its thing. I've got decades before I'll ever touch any of that. And so, yeah, that, I mean, truly, when we're talking about these quote unquote philosophies or theories, like my money is where my mouth is right now.
Yeah, I would say so that's great for accumulators, right? So
Mhm.
we've been generally talking about it from the from the perspective of someone accumulating assets over a period, they have decades left, right? Well, I will say as a caveat to those, because that instruction usually holds for everyone, but there is a small caveat that I will make that if you need money in a short-term manner for something, retirement, you're buying a house, you have some purchase you need to make, my suggestion is you raise cash and you leave that cash in a safe place for you to use that against that purchase. That way you don't, that way the short-term fluctuations don't influence your longer term goals and your longer term investment strategy. Um, but you should also, as you know, approach retirement and as you go, you know, start to retire and get comfortable in retirement, work with your financial advisor, tell them how you feel about your income flow.
Mhm.
um, because sometimes there are things that we can do to help it make it more secure, to help it to help you feel more comfortable living on your assets instead of accumulating assets. And when you're living on your assets, you're more sensitive to that up and down volatility. And so sometimes there's some things we need to do just to make sure that the volatility isn't too much so that you can stick with your investments no matter what the market is doing.
Mhm. Absolutely. Absolutely. That's financial planning 101, right? When we're looking at like when do you need money? That is one of the most important factors. If you need it soon, if you need it for regular living expenses, we don't put that money in the market. And I even have people my age, or 50s and younger who they'll have those questions. Oh, I have 10 or $15,000 sitting here, or it could even be like 70 or $80,000 sitting here. But I'm going, like, I'm between jobs right now, but I see the market is, you know, going to, should I buy XYZ stock? Like, when do you need that money? Like, well, I'm like, no, do not put that in the
Next month.
market. Right. Well, I might need it for this thing. Nope. No, if you need that within a year, then you keep that, go put it in a high yield savings account, right? Earn some interest on it, but don't put it somewhere where there is a possibility that it could be gone just as much as it could be there.
Yeah, I try to help people understand. I think people view stock investments differently than they do real estate, because real estate, one, is expensive to trade, right? You have to pay a 6% commission plus closing costs every time you do it. You have to find a buyer for the property if you're trying to sell. And I try to have people take that mentality and say that's the way you should be looking at your stock investments.
Mm,
I mean, the fact that you can trade with very low or no commission, okay, has given individual investors a um, a lack of cost, a lack of penalty for trading, and so they sometimes trade excessively. And so, just because you can doesn't mean you should. In fact, what I would say is if you want to trade in an individual account, I would say you think of it 3 times and find reasons not to, because you're probably making the wrong choice if you're trying to trade that. So you want to look at it like you own a business, and this business you can't just sell at the drop of a hat. Okay, so look at your stock investments that way. Even if you own an index fund, right? You can't sell it. If you had to pay a 6% commission, how fast would you sell that? Probably wouldn't, right?
interesting. That's such a good I like that. Like just like a temperance. almost,
Mhm.
right? Like just temper it. Um, and what it made me think of is, I mean, Juncture, and X squared, we're a fee only RIA, so we're not trading things on a commission. We don't have brokerage accounts for our clients, but there is a time. There are still people who do it this way, but there was a time where if you wanted to make a stock purchase, you're going to pay nine or $10,000 of commission to place, a $50,000 trade or whatever. I don't know. I never did it, so I just know it exists. And that would be, yeah, you would be a lot more hesitant to sell that stock if you paid 10 grand just to have the privilege of buying it.
Yeah, usually it was
Interesting.
1%, 1 to 1.5%. That's
Okay.
kind of the historic number. So round trip, it's a 3%, right? Which is why usually people would say, hey, buy and hold forever. You paid the 1.5% on the way in, and then you had front loaded mutual funds to begin with, where you
Right.
paid, well, it was 8% to start out with for a mutual fund, where you paid, and the first 8% goes to the mutual fund company. The remaining 92% was invested, and then you continue to grow. Well, because you had paid that 8%, you were not going to sell that for a very long time.
Right.
Right. And that mentality is a wealth creating mentality, in the sense that it forces you to stay in, because your thought process is like, well, geez, I gave them 8%. I might as well stay in this thing for a very, very long time so that I can recoup my money plus. So it encouraged very long-term holdings. Whereas no commission, free commission, no load mutual funds, ETFs, because it's so inexpensive to trade, I think it gives people too many, it's just too easy to make a decision point. So they're starting to act like everything is a short-term investment and
Mhm.
nothing is a long-term wealth creator. Um, and I think it should be the exact opposite. I think you should look at your stock investments just like if you bought a building downtown. If you bought a building downtown, it would take a long time to sell it, and it would be very costly. So you wouldn't want to sell it very easily. So that's the way you should look at your stock investments.
Hmm. Well, I like it. And we will wrap it up there for everyone. So just again, final notes for today. We're probably going to see some volatility. We might see some rate cuts from the Fed in September. September is going to be a little bit of a wild month here. So just like, I don't know, buckle up, hold on to your hats, all of the idioms that we can just throw at it, right? Just be aware and be prepared, and know that if you do see the volatility ramping up this month and in October, it's okay. It's going to be okay. This is average. This is average. It's good. We're fine.
Yep, we are totally fine. The economy's growing. It's going to start accelerating in the fourth quarter of this year, and all the political campaigning in the world won't stop that.
Well, if this sparked any ideas, any questions, we love to get your questions. We really appreciate it. I will. Oh, I wanted to share one story. So last week on Investment Friday, I shared um, a fairly vulnerable story. Brad, you weren't here, so you didn't hear about it,
No.
unless you listened. That I thought I was buying Taylor Swift tickets to take my daughters to go see Taylor Swift in Indianapolis, but it was full on scam. And so yeah, it did not feel good. And so I shared literally everything that happened, and how I felt about it and how my husband responded to me in that moment, that helped me to, not create like a shame response inside of me, because, if someone tells you, "Hey, that was a really stupid thing you did," on top of you already feeling really bad about yourself, that coalesces itself into shame, inside. And so I shared all of that last week in the hopes that anyone else who heard that, or saw someone selling tickets or heard, your sister or your friend is thinking, "Oh, I can buy these tickets. Do you want one?" Let's put a pause on that because let's really check and make sure it's not a scam first. And after I shared that, and the reason I'm saying this is that someone that I know reached out and was like, "Thank you for sharing. Thank you for being vulnerable. That was such an amazing like thing that you did to share that." And I think I might have like just missed being scammed almost that exact same way. And she was trying to purchase Savannah Banana tickets. So if you've ever heard of the Savannah Bananas,
No,
they're a minor league baseball team. They're a
that is
minor league
awesome.
it's hilarious. You should go look them up. Look them up on YouTube or TikTok or wherever. They're basically like the Globetrotters
Oh, okay.
of minor league
Baseball.
baseball. They used to be just a normal baseball team. And then they decided to like do something different. And it's if you listen to Mike McAllowitz, he's written quite a few business books. He's used the Savannah Bananas as an example of building a really creative business. Awesome examples. Anyway, she had that exact same like experience, like the beginning of the experience, person being super pushy, and then it just didn't work out for her family. And she's like, "Oh no, 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 I'm not going to buy those right now." But she hadn't thought until that moment that it never occurred to her that there might not have been any tickets on the other side of that. And
It
so
happened.
that, right? It's just like that someone wanting to have an experience. These ticket scams, right, are like really prominent out there. So I appreciate again, I really appreciate when people share their experiences, share their reflections. Um Yeah, if you've been having any questions about the political cycle or the presidential cycle and how it affects the markets and this brought anything up for you, love to hear from you on that. You can always get me at Hannah, Hannah, at expansiveceo.com. And Brad, how can people get a hold of you?
You can email me at Brad Haines, or excuse me, B Haines at juncturewealth.com, or you can call our number 480-253-4100 and leave a message and we'll get back with you.
Love it. All right, everyone. Stay safe, be aware of what's going on, but don't be afraid. That's our message today. Don't be scared. It's all
That's
going to be
right.
okay. That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, Hannah, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.